Hi, CMattDye here. Thanks for stopping by and checking out today's video. I have a little bit of a different one for you today. Today we're going to talk about the Silicon Valley Bank, what led up to it, the reasoning for its failure, and then the bailout that the government is stepping in for. We're going to talk about why risk is so important, and I think this particular situation really does highlight that. So the biggest failure in U.S. bank history was the Washington Mutual Bank in 2008 of $307 billion. That was pretty wild. So the second one is Silicon Valley Bank. They have $209 billion in assets, $175 billion in deposits. But, not every asset is created equal. And I'm sure you know that. I know that. Everything is different. So how did this begin? Well, this began back in 2009. And it was an issue. It was an act that was created after this 2008 financial crisis to help. But we know that not all regulation is helpful. That's why a lot of people in crypto are against regulation, but a lot of people are for regulation because they know that some regulation is good, and it is. The regulation like it's against the law to go out and kill somebody. That's great regulation. I don't want someone just to randomly shoot me one day when I'm walking down the road. So that being illegal is good. The regulation where FDIC insurance on banks. I can put my money in a bank and I know that it's going to be insured to a certain amount. That's good. And now we're going to talk about some bad regulation. So in 2009, Frank and Dodd enacted a bill to help against the financial crisis. So they tried to work on leverage in certain situations. They made it basically illegal to use certain leverage, like in the Forex market, for example. You've probably heard me talk about that, maybe if you watch my videos. But then they decided that treasuries were a no-risk investment, which every investment ever has some risk associated with it. Some investments have very low risk, some investments have very high risk, but they all have some type of risk. So that was a bad thing. So they said treasuries are a no-risk investment. And for a company like this bank, for example, if they put their money in treasuries, then they don't have to actually report that on their quarterly statements. They if anything changes, they just have to put a little footnote. So that's where our debacle started with that bill. Now that's what Silicon Valley Bank was doing. Most banks, what they do is they could take a deposit and they keep 10% on hand, and then they invest the rest to get that little arbitrage. So that way they're whatever interest that they're paying to get that deposit versus how much interest they're making elsewhere. And usually you invest in treasuries. And most banks will have long-term treasuries and they'll have short-term treasuries. And treasuries, maybe you're getting 2% on your treasuries, but if it's a 30-year treasury, you have to hold it for 30 years to get that payout. Or if it's a 10-year treasury, you have to hold it for 10 years to get that payout. And then if you sell it prior to that, it depends on the market, and that's what we're going to get into. So for Silicon Valley Bank, I want to talk about this really, really quickly. So Silicon Valley Bank had no official risk officer for 8 months while the VC market was spiraling. That's pretty large. And if we scroll down here, Laura was the CRO. She stepped down from her role in April of 2022. She formally departed the company in October, but she stepped down as a CRO in April of 2022. They appointed her permanent successor in January of this year. So from April to January, they had no risk officer. Why is that important? Well, I took some notes. The Fed raised rates Over the last year, 450 basis points. That's huge. And over the last 7.5 months, 375 basis points. What does that actually mean? Well, if the Fed raises rates, that short-term treasuries are going to do better than long-term treasuries as rates are rising. So the long-term treasuries are going to be underwater and they were underwater for SVB Bank. You can see that they had $12 billion on their balance sheet, but they were $3 billion insolvent. And then right here happened. This happened about a week and a half prior to them becoming declared insolvent officially. The CEO, Greg Becker, sold 11% of his holdings. The CFO, Daniel Beck, sold 32% of his holdings. And the CMO, Michelle Drape, sold 28% of her holdings. And that was around $5.1 million. Like that's crazy. Why did they do that? Well, they knew that they had a quarterly statement and they had a footnote because that's all they had to disclose. They didn't have to disclose their entire treasury portfolio because it's declared a no-risk asset by Dodd and Frank. Great people there. Actually the opposite, but for humor's sake. So because of that, they were sitting underwater with these positions and they knew they needed to get rid of them. So their plan was to sell them, and that way they could clean up the balance sheet. And the reason why they needed to do so was they knew Moody's was going to call and they were going to downgrade them by 2 credit scores, which is pretty large. Like if you go from an A to a C, no one wants to invest in you. If you go from a B to an F, no one at all wants to invest in you. So they were wanting to sell stock. That's what they were going to do. They're like, okay, well, what we can do is we can get rid of some of our position and then we can sell some stock to raise capital. And Moody's came calling and they were like, well, what's this footnote on your balance sheet? We want to know if it's a mark to market versus the way you're claiming. How's that affected? And then what they did is they went out and sold some stock. And they had a little bit of help. And Jim Cramer, this was February the 8th, 2023. He went on his show and started pumping SVB Financial, which is Silicon Valley Bank, talking about how it went up. He thinks it's undervalued. And, not a really good look, especially, for this guy. Probably needs to retire. But if you would have done any due diligence in the company or anybody, you would have seen exactly what Moody's saw. And it would have triggered a lot of inquiring. Now fast forward to a few days ago, they're getting a bailout. SVB, the government, they're getting a bailout. They're saying yes-ish, but this isn't 2008. Well, technically it's the same thing as 2008. The difference is they're not using the word bailout because they don't want to say this is the same thing as 2008, because technically it's kind of not, because 2008 was mostly started by mortgage-backed securities and people were over leveraging in that particular market. And this one, they kind of just took their eyes off the risk and just kept their investments going, which was very neglectful, and it was hurtful for everyone involved. And what the government came out on March 12th, so the Treasury Department, the Federal Reserve, and the FDIC all announced that they were taking decisive actions to protect the economy to shore up confidence in the banking system. They said they would make sure all of SVP's depositors would have access to their funds by the next day, not just the $250,000 guaranteed by the FDIC. So we know $250,000 up to that point are guaranteed by the FDIC. Well, in Silicon Valley Bank, 90 to 97% of the deposits were over that 250,000 FDIC limit. And that is why this was such a big deal, such a big story, because they knew that most people did not, they were over that limit. So that money would not have been guaranteed, but now it is. So what the government decided to do, and it's funny that I think the press secretary was saying that they're not going to do a bailout, and then they do a bailout. So what they're doing, they're saying it's not a bailout because they're not printing new money for it, but they're still taking money from the treasury. So there's a exchange fund, and I think it's $100 billion. This exchange fund is for propping up the market if something bad happens. So that's what they're taking money from. They're taking money from that fund to use in this bailout. And that fund, somehow, at one point, money came from the treasury. It was printed and it was put in that fund. And now it's being used. So technically, it's the same thing. It's a bailout. They're just trying to use different lingo. For some reason, the current administration likes to change the narrative a little bit, and that's what they've done the whole time that they've been in power. They like to change the narrative a little bit. It's basically a bailout, and it's kind of needed. You know, you don't want to have a run on the bank. You know, it started. You know, people were hearing that they were underwater. When they tried to sell their treasury, they did sell a little bit. People started looking into them a little bit more, and they did start actually taking money out. And because they were insolvent, they didn't have the capital, and that's why a bailout had to happen. Because if not, people would have gotten scared. They would have taken their money out of that bank. They would have started taking their money out of other banks, and it would have, it would have been terrible. So this was needed, but it's a good story for risk. It's why is risk important? Well, here's a great example. This is, and treasuries aren't that risky. They have a low risk percentage usually. So treasuries would be low risk, whereas, buying or investing in a startup restaurant would be pretty risky because 90% of them fail in the first year. Investing in treasuries would be fairly low risk because you're going to get that payout as long as you hold to maturity. So that's kind of how that works. But I just wanted to highlight this story, talk about it. Some people might not know the details. They might be interested. But I do want to talk about risk a lot because, I come from traditional finance, been trading and investing for a very long time. And I've seen a lot of people look at risk as very, as not that important. It is super important. Here's a good example. So hopefully you did enjoy this little story here. If you did, hit up a like. I'd appreciate that. Comment section down below if you have any comment suggestions, anything like that. Thanks for watching today. Have a great rest of your day. I'll see you around the crypto markets. Take care.